Hello children, welcome to the digital classes of Christ Church Convent Higher Secondary School Gadarwara. This video is for class 12th. Subject is economics. Chapter 3, Money and Banking, Part 6. This is conclusion part of this lesson. First topic of this video is open market operations. The meaning of this word is sale and purchase of securities in the open market by RBI. This is a weapon to make control over credit creation. Whenever the securities like NSC, KVP, Kisan Vikas Patra, National Savings Certificates, like such securities are sold in the market, then RBI tries to soak the liquidity from common people so that the excess amount of money with common people can be reduced and so as for the economy. And when securities are bought by RBI, then it releases liquidity. Soaking of liquidity from market is done at the time of inflation to curb inflation, so that public cannot demand for more goods and services, and dearness can be reduced by making a proper balance between demand and supply in the market. And buying the securities is a tool to rectify the state of deflation, where liquidity is provided, or you can say it is released in the economy, and that liquidity form, yani ki cash, can be used to purchase goods and services, and it gives an impulse, a pace to economy. So we can say that when liquidity is soaked, then it leads to fall in cash reserves of the commercial banks, and resultantly they cannot make credit creation as per their wish, due to which there is a fall in money supply and thus inflation is curbed. Second thing is qualitative instruments. These weapons actually are focusing on increasing and decreasing the flow of credit to specified areas of economic activity, out of which first is margin requirement. Margin requirement is the difference between the current value of security offered for loan against collateral security and the value of loan granted. So when a person seeks loan against collateral security from commercial bank, then it is valued by the valuer of bank, and 100% amount of the mortgaged assets is not given as loan. So that margin requirement is totally differ, means it has got a difference with the current value of security offered. When the margin requirement is raised, the supply of credit needs to be curved. And when margin requirement is lowered, so it means the supply of credit is to be increased. Normally, margin requirement is kept high for trading activities. It means that if a person is requesting a loan of rupees 1 lakh from the bank, for which he'll have to mortgage his property, his assets. If the current value of asset is rupees 1 lakh, then bank will provide him only rupees 70,000 or say 80,000. Full amount equal to the assets will not be given. So margin requirement is kept high for speculative purposes like in trading and other things. When it is increased, margin requirement is increased, then there is less demand for credit, and there is a fall in the supply of credit by the commercial banks, due to which money supply is reduced in the economy and inflation is curbed. Vice versa, when we talk about fall in margin requirement, so there is rise in demand for credit, and there is a rise in supply of credit by the commercial bank, and excess money supply is done in an economy so that deflation can be curbed. And third weapon is rationing of credit. Rationing is a word which directly related to quota, credit quota for different businesses activities. It is implemented by RBI, means through the guideline of RBI to commercial banks, when the flow of credit needs to be checked, particularly for speculative activities in the economy. Then RBI fixes credit quota for different business activities, and commercial banks follow the guideline of RBI. They cannot go beyond that limit, quota limit, while they are sanctioning loans. So it makes a restriction in the supply of credit in the economy, and inflation is curbed. When there is a need of rationing credit, it means economy is suffering with the state of deflation, then that restriction is abolished for a period of time so that the money supply can be adequate in the economy. And what happens? when there is a rationing of credit implemented, it decreases the supply of money, and commercial banks cannot make more credit creation, and dearness can be controlled. And when this is means rationing of credit is withdrawal from the economy, so result is increase in supply of money, empowers commercial banks to make more credit creation. It gives them a room, due to which demand for goods and services increases, and economy gets a dynamic move. So this is the third weapon. And this was the last topic. One more topic is there in your book, that is difference between central bank and commercial bank. So we have already talked about the features, functions and objectives of these two banks. So on the basis of that, you can compare them. So while ending this lesson, you just go through once that difference. Normally it comes in the examination. So this is the end of this lesson, money and banking now. Thank you.